Hey, this is Kina Knisley, and I'm with Keller Williams, and this is Coffee Talk with Kina. And today I have Sean Uyehara from Geneva Financial, and he is going to share about this phenomenal loan that I just learned about. So thanks for joining us today.
Y-
How is everything? And you're currently in Las Vegas, right?
Correct. Yep.
But you can loan in Hawaii. So
Yep.
so tell me about what kind of loan are we going to talk about?
Morning sun is shining. It's a brand new day.
We've been using our first lien HELOC program. So it's a home equity line of credit that you can use to either purchase a home or we've been teaching a lot of our clients to use this to get out of mortgage debt substantially quicker than your traditional 30-year fixed mortgage.
So how is this working? Because it's super interesting. I kind of said at your presentation that I was like, both my husband and I were like, wow, I had no idea. So let's start like, okay, you got a buyer. He's going to buy a home in Hawaii. What's the first steps he needs to do?
Same process, just like a regular mortgage. They want to get pre-approved first, make sure they know their numbers and they can qualify. But if they're going to use this strategy to purchase, the minimum down payment is going to be 10%. And you have to have at least a 700 credit score to qualify. And all you're doing is you're using your HELOC essentially as your checking account. So any deposits that you make, whether it's your income or rental income or any sort of income that you generate throughout the month, ideally you want to move that money into the line of credit because any deposit that you make reduces your principal balance dollar for dollar. We're going to use the HELOC to pay for all of our expenses, just like we normally would. And any of the excess cash that's left over continues to live in the HELOC for the time being to help force the pay down of the mortgage. But because it's a line of credit, you still have access to that cash for 30 years. So if anything, over time, we're creating more liquidity for our clients and we're using the daily interest calculations to work to our favor. So that way we can pay off our homes. Typically, we see a lot of our clients range anywhere from maybe 3 to 7 years that they'll typically pay off a home. Obviously, if they got a lot of money, they can do it quicker. I just talked to a gentleman from Hawaii last night. He's got 10 years left on his house, but we'll pay it off in 2 years for him.
So is the payment going to increase for him then? Like, does he have a
There's no payment on the HELOC. So all you're doing is you're just making a deposit into the line of credit. Any deposit that you make reduces your principal balance for you.
So he doesn't have to make a house payment every month. He just
Correct.
has to use it as his checking account.
Correct. Yep,
Because
exactly.
I know we even asked you, like, as realtors, our income, we're up and we're down and we're up and we're
Yep.
down. And you said that would even work for, people like us that don't have a consistent paycheck every 2 weeks.
Yep. As
Um,
long the big driver on the loan is having some residual at the end of the month, or you could even see at the end of the year, right? Because if your income fluctuates month to month, the months that you might be a little tighter on income will, offset by the months that you're doing, double or triple the amount that you normally make. So as long as it averages out where you're ahead of the game as far as income versus your debt, there's a good chance that this strategy can work for you. If someone's living paycheck to paycheck, it doesn't work at all.
okay, so what if they have a lot of equity in their home? So say they paid $1 million and now the home's worth 1.6. What would it look like in that scenario?
We'd pay off the existing $1 million mortgage, and that would turn into their home equity line of credit, or they can borrow up to 80% if it's their primary residence. So it just depends on what the individual wants to do. If they don't want to invest or have a bigger line of credit, then we can just pay off the existing mortgage that's there.
So they would use it as their checking account.
hmm
And then I guess I don't understand. So okay, say I get a commission, it's 25,000 and I have this type of loan, I refinance into this type of loan and I put that 25,000 in that month.
hmm
What happens?
You reduce your principal balance by $25,000.
Now, and I still need to pay, for groceries
hmm
and, my car insurance and gas. Where does that
Yep,
money come from?
from the HELOC.
So I'm going to have a HELOC that is going to be as big as my equity, or
No, it's going to replace the mortgage. It's going to replace your first mortgage.
all right. So I'm just my own bank. So
Correct. Yep.
I'm going to take my money back out to pay my bills.
Correct. Yep.
Wow. And then people can pay their homes off in 5 to 7 years.
In years, yeah. We can
Yeah. So
eliminate decades off the mortgage.
yeah, and that saves a lot of interest because I just had a buyer reach out to me and he said, no, I'm not going to buy right now at these interest rates. A $500,000 house is going to cost me $600,000
Hmm.
over the life of the loan. Now, of
Yep.
course, my response was, are you going to keep the house for 30 years? And he's been renting, right? So he's not paying anything. He's paying someone's mortgage, just not his own. Uh,
Hmm.
so in his case, he this would probably be a good thing for him, right? Because if he buys a $500,000 condo, because he's not getting a home in Hawaii, or at least not applying for that, but not getting a single family home. So say he buys a condo for
Hmm.
500,000, what can it ultimately end up asking or costing him?
I mean, it just depends on what his income and his cash flow looks like.
So, well, so I need to connect him with you so you can
Yeah.
walk him through this
Yeah.
because
Anybody that's buying or that has a mortgage, to me, this is the most efficient and effective way to manage it itself. There's no reason to stay in a 30-year fixed mortgage if you can get out of it within a few years. Because
now,
once you're out of the mortgage, you have access to that line of credit. So whether you decide to buy more real estate, whether you want to just invest the money, or call the bank and say, hey, I don't want this line of credit, close out my loan and give you my deed, they can do that too. But when you look at the fact that you have access to hundreds of thousands, or even some of our clients have millions of dollars on this line of credit, they want to buy a business. They want to do something that's going to create wealth and a legacy for their family versus, what a lot of us, the only way we can fathom paying off a home quicker is your typical, I'm going to round up to the next maybe $100 or $500. I'm going to make biweekly payments. I'm going to make an extra payment here and there. And yeah, that might shave off, 7 to 10 years of your mortgage, but you're still in that thing for 20 years, right? And that's assuming you never refinance. And that's assuming you never take out a HELOC on your house. Because the minute you do either of those two things, you've now deviated from the payoff. And I think that's where a lot of people that I start to see where they bought, during 2020 and 21 with 2, 3, and 4% interest rates, they get HELOCs on their houses and they still think they're paying 2% or 3% interest. No, you're not. The minute you took out that HELOC, you're no longer paying a 3% interest rate on your mortgage, right? Your blended rate's probably going to be somewhere between 5 and maybe 7 or 8%.
oh, oh wow. So yeah. So I was going to say, what about these people that got their houses, bought during that crazy time when it's
Hmm.
2.5 to 3%? Is this still a good route for them to go, even though they
Yeah,
have a loan?
absolutely. Because if we can look at the effective rate on a mortgage and let's say we can get it down to 1%, 1% still cheaper than three. And time, right? You can't get back time. So if you're stuck in a mortgage and let's say you've been in it for 20, you have 25 years left, and I can show you how to pay it off in, let's just say 3 years, there's no way you can argue with me and say you'd rather make a mortgage payment for the next 22 years of your life and you're going to be happy about doing that.
Yeah. So
Hey, unless you want to do it, right?
yeah.
The bank will gladly take your money,
Oh yeah.
but I'm
It's
all
because it's
for,
what our parents did, right? I mean, that's
yeah.
the mindset I think people have. Our parents, went through life, got a loan, paid 30 years, stayed in the home. And so I think that's what we're used to. But I think our parents were also paying maybe a third of the price for homes, probably higher interest rates, but a third of the price, right?
Yeah.
So
Yep.
now, what are the drawbacks for this loan? Like, is there anything bad that could happen?
No, no, in my opinion, I don't think there's anything bad with it because, well, let's say these are some of the arguments that I hear. People will say, well, you're giving somebody access to a line of credit, and what if they spend, they start spending all their money? That's not a problem with the loan itself. That's a borrower problem, right? Because you could still refinance and do a cash out refi on your home on a 30-year fixed mortgage and go blow the cash. You could take out a second mortgage on your home and go blow the cash. So is that the loan's fault? No, that's the borrower's fault. Other people will then say, well, the interest rate, it's adjustable, it fluctuates. And I think a lot of times when people make those statements, they don't even understand how an adjustable rate mortgage works. All they know and they assimilate it to was what happened in 2008,
Yeah.
right? So it's an adjustable, oh my God, foreclosure crisis. That's all they know. But if you look at a lot of wealthy clients, they'll take adjustable rate mortgages because they know that they're going to either pay the home off before the adjustment. There's going to be something in that mortgage that'll benefit them right now. And if you see a lot of HELOCs, they're starting to adjust downwards because the Fed is making their announcements to cut rates, right? So as the Fed cuts rates, HELOC rates start to get cheaper, not mortgage rates. Mortgage rates have actually gotten worse. And I think that's where a lot of people, again, they don't understand interest rates. And they always say, I've been doing this almost 20 years. Every time the Fed cuts, we get phone calls. Hey, I heard mortgage rates went down.
I
No,
know.
they didn't. Right? It's like during COVID when they announced rates almost at zero. Oh, mortgage rates are almost 0%. No, they're not.
I know. I get the same calls. They don't
Yeah.
understand the Fed rate is not your mortgage rate. And it's
Yeah.
really not dependent, right, on the Fed rate. It's the Treasury
Yeah.
bond rate that really
Yeah.
impacts it, which
Yeah.
I don't understand enough to explain it, but I'm always like, no,
Yeah.
no. So,
Yeah, so the downside, I really don't think there's a downside to it because this loan is really driven off of cash flow. And cash flow is what we can control as a homeowner, right? Your deposits that go into the HELOC, that's the money you make. And the money that's left over is based off of your spending habits. So if you're living again paycheck to paycheck, this doesn't work. But that's not a loan problem. That's a you problem. You need to get your finances in order. That has nothing to do with anybody other than yourself taking accountability for your budget. Now, if you have money that's left over and you're in this program, I always tell my clients, nothing should change. Your life doesn't change because you're in a different mortgage. Everything stays the same. You're still going to make the same amount of money, if not more, and your budget should stay within range of what you're doing now, unless you decide to go spend more money, which again, that's not a loan problem. That is a you problem. You're choosing to make things different on your budget. So as long as things are within reason, there's no reason why this thing should backfire on them at all.
so now what if somebody does run into a problem and they can't put any money in that month? Does it impact them, like a negative, like it does, with your mortgage if you miss a payment?
So the interest will still accrue to the loan no matter what. So if you had a month that you made no money, you made no deposits, as long as you have enough available equity to absorb the interest costs, you're totally fine. So this is kind of where like we were talking about being self-employed or you have these fluctuations for people that are 1099 or you're commissioned. Okay, one month maybe you make 10,000, maybe next month you make 5, but then the next month you're making 40. So that $40,000 deposit makes up for the months that you weren't making, a larger deposit. So that's kind of where we'll look back maybe 12 months or 24 months and just see what's the average amount that the client deposits. And we can model the simulator based off of that number, kind of taking a worst case scenario. Same thing with the budgeting. Obviously, if you're making less, you might be spending more that month. So we take it into account over the last 12, 24 months, however long the client wants to go back, they can see what their average spend is going to be, and then we can model these numbers off of that. And same thing with the interest rate. We can look at a higher average rate. We can look at a lower average rate. So we can model different scenarios for the client to show them that, again, the biggest driver on this loan is going to be their cash flow versus the interest rate.
But wow. So now this works for your primary home and for investment properties?
Correct. Yep.
So if you bought an investment property and it was going to cash flow or at least break even, this would work?
I would look at it. Yeah. Because, a lot of investors, especially if it's a long-term hold, you're probably not cash flowing today.
No.
And depending on the market that you're in, right? Unless you're putting a substantial amount of money down, maybe you're in a negative cash flow position, but let's say the rest of your finances look pretty sharp. This might be a way that you could purchase a home today and maybe you pay it off within a few years and now you've got access to that line of credit and now you can keep buying more properties versus sitting on the sidelines, hoping and praying and wishing interest rates come down to 5% so you can cash flow and purchase a rental property at that time.
So wow. So what is anything else somebody needs to know to get this loan
I
other than
think you just
call
have
you?
I think you just have to be open-minded. I get it's a different strategy and it's a new way to think about a mortgage. It's not anything new. It's been around for decades. And I think as long as you're open-minded to learning the strategy, you can see if it works for you. It has nothing to do with me or my team trying to sell this to anybody. I just believe in educating people and empowering them to then make the decision because there's a lot of folks that we've shown them you can pay off. I had a guy, we could pay off his $1 million house, his mortgage in 3 years. He didn't want to do it. He had a 3% interest rate and he felt he was better suited staying in his mortgage for the next 27 years.
Wow.
I think I would have taken the $1 million payoff and we would have saved him almost $1 million in 3 years. To me, I would have done that all day long, and
Yeah.
then there was another gentleman, we could pay off his home in, I think it was around 4 years. Same thing. He had 20 years left on his mortgage. He didn't want to do it. So, to each their own. Everyone's got a different path to their financial independence. And I think you just have to decide for yourself, right? If the path that you're on today, if it's going to get you to your goal, then great. Hey, more power to you. But I think for a lot of us, there's almost a doubt, like, can we actually get there? The debt has skyrocketed for most people, personal
Yeah.
debt. And you think of your mortgage and other than student loan debt, those are the two biggest problems that for most people that we face, whether it's our own student loan debt or for our kids. So at what point can you actually retire? Right? And do you have enough money saved up in retirement? And I think those are all questions I think a lot of people ignore or they don't really know the answer to it, or they're hoping that they have enough to call it a day. But there's a lot of reports that have come out over the last few years that have shown more and more that people are underfunded in retirement. They're working longer years, right? And so you have to ask yourself, are you even going to be able to retire? And
Yeah.
for me, I think the average person, that answer is no, and they just don't want to cross that bridge and realize it. I think they'll work till they die.
Yeah.
So this thought of, hey, homeownership's the American dream, I disagree with that. I think it's a nightmare for most people. You're in a house, your taxes are getting more expensive, your HOA is going up, your insurance is skyrocketing. So the maintenance and just the homeownership cost itself, it's out of control. So again, if you can get out of debt quicker, I don't see how that's going to put you in a worse off position when the first of the month rolls around and you don't have to make a mortgage payment.
Yeah. That's huge. So if somebody wants to talk to you about this, how do they get a hold of you?
They can send me an email and I'd be happy to hop on a Zoom call and go through their specific scenario and just see if the numbers work out. We go through a simulator with everybody and the math tells us, if we're going to achieve some time savings on the mortgage as well as the interest savings. And that's the two things that we really want to shoot for.
And they can do it on their primary home or an investment property that they own.
Yep, even a vacation home as well.
Wow. So, all right. Well, we will throw your phone number and your email up on the screen. I definitely am going to connect you with some people. I'm going to connect you with my guy, thinking it's going to cost him 600,000. He's probably right. He's not wrong, but this
Yeah.
might be perfect for him. So
Yeah.
be connected. Well, thank you so much for joining us today. I've learned so much, and thanks for coming to the RIA group. We do meet again this Thursday, so I'm super excited.
Yeah.
But yeah, all right. Well, I will. I'm sure I'll
Alrighty.
talk to you soon because I have clients I am going to send your way.
All right, awesome. Thanks for having me.
Yes. All right. This has been Coffee Talk with Kina, and I will see you next time.
Morning sun is shining. It's a brand